All right, so you sold a covered call, you think all things are great, and then all of a sudden, like earnings or something happens, and the stock price shoots way beyond your strike price, and you're like, oh my gosh, the value of your option just goes to shit, and you think you're screwed. There are some ways to get out of that option, especially as we get close to expiration. That's what this video is going to be talking about essentially. I have all four of my wheels have shot up way above my initial strike price. So I'm going to show you how to roll an option. One of the most crucial things, or one of the greatest tools to learn when you're trading the wheel strategy, is being able to, one, close that option if you need to get out, but also be able to roll it for even more credit or sometimes a small loss to keep yourself from getting ultimately screwed. So as most of you guys know, I am mostly a weekly expiration trader, meaning most of my wheel stocks are going to be just weeklies. Sometimes when my life gets busy or in the summertime when I'm not working as much, sometimes I'll go monthlies or if I want to slow things down. But most of the time, if you've seen my videos, my average trade is usually about 4 days. That is not the case with what's going on right now. If you looked at my expirations, you'd say there's no way this guy is a weekly trader. In the 4 stocks that I'm trading the wheel with right now, I have a January 2024, a March 2024, an April 2024, and then a January 2025, over a year out in expiration. And all of those happened because I had to continue to roll those options as they went way above the strike price that I started them with. I mean, in the last couple of months, guys, I haven't held any options really till expiration. This one in here in blue got assigned early, and this one here got assigned. But other than that, you can see over here in the column D, I roll pretty much every single one of my options just to continue to keep getting net premiums. I'm going to buy to close, and then I'm going to open a new one. So let's show you exactly what I mean and when you might want to do that. I'm going to use Amazon as an example because it's the one that's closest to my expiration, but here's my entire Amazon log. Going back to February 16th, 2023, I started with a cash secure put, and then I just got rolls and rolls and rolls and rolls, and then another cash secure put, and then a roll, all the way down to here. The last cash secure put that I opened was at a strike price of $134, and it had an expiration date of 11/3. Now I got a net premium of opening that option, okay? So sell to open for $79. Now what happened was Amazon shot way past that strike and went above 134, okay? That's going to increase the value of the option, which as a seller is not a good thing. If I had bought an option long, that would have been awesome. And as we can see, it got up to $245 pretty much a day or two right before expiration. So here would have been my options in that case. I don't know exactly what it was, but maybe it went up to maybe $138, let's say. All right, so I have an option of rolling and not losing any money because I closed for $245 and I opened again for $243, so I lost $2, but I rolled it up $2 in strike, which got me $200 more. That's a lot of numbers, especially if you're a beginner. But most people are going to let that option just expire, and they are going to have to sell their shares for $134 when they're currently worth $138. That's a $400 capital gains loss, and you're going to lose your shares. By rolling, I can bring my strike price up, my expiration out, give myself some more time for things to go my way, and also keep hold of my 100 shares. So on that roll, if we can see, I started with $79, but then I had to buy to close for $244. At the exact same time that I bought to close, I sold to open, this time a week out, 11/10 in expiration, and for a strike of $2 more. So by going from 134 to 136 upon assignment, that $2 now equates to $200 more in capital gains I'll get if I'm assigned, as well as a credit or a small debit. Like I said, I lost $2 here to increase my position by $2 in strike and move it out 1 week. Well, Amazon continued to rip and tear, and we can see right before that expiration, a day or two before, I'm usually going to do this roll on like Wednesday or Thursday, depending. The value of this option went from $243 when I opened it on the 1st, all the way up to $708 when I closed it on the 7th of November. All right, so that lost me $465. So 2 trades, I lost premium, but at the same exact time, I bought to close this for $708. I sold to open another one for 778. All right. And I pushed it out in strike to January. Now, this wasn't a 1 week move. This was a couple months, and I'll explain exactly why that is. But we can see 142. So when I first opened this trade back on 10/27, I had a strike of 134, and I started with a $79 credit. Now I am at $142. Let's change that format so it looks nice. I'm now at 142, so almost an $800 capital gains difference. Still own my shares, and I am going to be at a net credit because 166 minus 165 to 178, it puts me in a pretty good position. I just did the math on that. It got me to 147. So I started with a $79 premium, but I'm currently at 147. Now, why did I roll it way out till January? Essentially, Amazon went up into the 140s, all right? So by going up to 142, I have to make the decision of, all right, do I want to come close to the strike price and not have to worry about this for a little bit? Or do I want to do what I did the week before? If it's kind of close to the strike and I only need to go out a week or two to maybe hopefully hope that it goes down. So the average cost that I paid for these 100 shares is $138. So essentially, unless you know how to roll, you should not be writing any strikes below 138. I did because I know how to roll, and this will show you that once you gain skills, you could take a little bit more risk. So currently right now, that's returned me $910 with the current share price at 147.10. So that is still way above my current strike price, right? I'm $5 in the money, but when you start to learn about this stuff, you see that I sold this option for $778. So the buyer of this option still not at break even, which is good news for me, and I can still let this breathe. But this is a win-win trade for me because if I'm assigned early, I have to sell them for 142.50 when I got them for 138. Now, granted, I'll lose some capital gains, but this is not a dividend stock, so there's really no risk of me getting assigned that early, especially this early out. Buyers, the buyers are going to lose money, okay? So I probably just pushed it out enough where I didn't have to worry about it and tried to get it close to the money. So if we look actually inside this option, okay, I paid $778. It's currently at a value of $838. So if I want to buy to close this option, I'd have to buy to close for $838. And that's the thing you have to think about if you want to roll. Let's say hypothetically, here's my option and I need to roll. It's a day out from expiration and here's what you need to do. What I am going to do is I'm going to look at the current buy to close. So I'm going to open up the options chain, and it doesn't matter if this is Robinhood or anywhere else. I'm going to open up the option chain and say on January 19th, I have to go to the actual option, January 19th. I look at the strike of 142. Now you can do this all in one move. That's the roll, or you could do it separately. You could see the -1 here because that's what I have open. Here's what I do. I'm going to buy. So up here's the buy, and I'm going to buy a call. To close an option, this would just be it. You buy the opposite. So if you want to close this option, I didn't want to roll it, I would buy to close, I would click this button, I'd pay $838, and I would lose $100 because I sold it for $738. But I want to roll. So once I'm going to click this option, it's going to start to be up here, right? Now, after I know that I have to buy for 138 and it's a 142, I'm going to switch to the sell side, and I'm going to say, well, this is the same expiration. Let's go out one expiration and see if I can better my position, better my strike, or better my expiration. By going out, you are going to better your expiration. So 142.50, this is so far out that there isn't even a 132.50, a 142.50 option. But right now, I can sell for $13.25. Now, these are going to be a little off. This is the weekend. The markets are not open and options don't trade. But this would be a great move for me to go up to, say, 145. If I were to click this, we could see up here in the top right, I buy for $838. I sell at the same exact time, moving up in strike and out in expiration. Now I get myself another credit of $175. And that's exactly what I've been doing. You want to either better your strike or better your expiration by looking at what you have to pay to buy to close and then going out in expiration to see where you will get a net credit when you sell. So right here, I have an Apple call for April 19th, 2024 at $190. So I'm going to open that up. I'm going to go to April 19th, 2024 for $190. There it is. Let's say I wanted to roll this option right now. I need a buy, call. I need to pay $12.40 or $1,240 to do that. So now my strike better be higher than 190. I'm going to move out an expiration to the next expiration, which is June at this point. Like I said, as you go further out, those expirations are going to space themselves out. If you're closer or doing this in a week or so, you could just jump to the next week, 2 weeks, whatever. But if I go to June 21st, I want to write 198. Boom, I got myself a 1588. That's going to be a huge credit for me. If I have to go to sell, click this. Now I'm going to get another 348. But I can also see that maybe I want to go up to 195, right? That's a $5 up in strike, which is a $500 capital gains, right? And I can sell here. I'm going to pay $50 to get $500 more of capital gains on assignment. That's a net $450 win if I'm assigned early. So this might be a play that if I was getting close to expiration, I might want to push it out. So those are the things that I'm going to be thinking about when I'm rolling an option. I got to buy to close, and then I got to sell to open at a price or a premium that is greater. That's going to give me the net, and I'm going to do so by pushing either out an expiration or going up in strike to better my position. I know this can seem confusing, guys. You can leave questions down in the comments below. I'll definitely get to them. Or hop in the Discord for a cup of coffee a month. You can talk to me all day while we're doing this. I also have a full guide and strategy book that you can get on Amazon, printed right to your house. Also super affordable if you want everything organized. This is the wheel strategy, top to bottom, opening, closing, calls, puts, you name it, guys. And it's another great way to support the channel. I appreciate all you guys. I'll catch you on the next video. Until then, be positive, work really, really hard, and always, please, be kind to other people. Just be kind to other people, and happy holidays, guys.